Welcome to the Canadian Investors course, Session 5, Economics that Move Investment Assets. As with all the previous sections, please review page 2, Terms of Use and Disclaimer. A client is saying to an advisor, "I retire on Friday and I haven't saved a dime. Here's your chance to become a legend." Investment advisors love it when people come in and say things like that. Please remember that this is not an economics course. However, there are basic events and items that an investor needs to watch for. First of all, from the government, keep an eye on the Federal Reserve. Second of all, interest rates. Monitor the yield curve. Thirdly, currency. Currency is always a factor, especially if you're an international investor. And fourth, not to be ignored, the economic cycle. Don't forget, just about the time that people start saying it's different this time, they usually discover it's not. Government. Fiscal policy and monetary policy are the government's tools for adjusting economic policy. Fiscal policy involves the government changing tax rates and levels of government spending to influence demand in the economy, consumer demand, corporate demand, and so forth. Monetary policy involves changing the short-term interest rate and consequently influencing the money supply. Fiscal policies. What can elected politicians do that affects the economy? Well, they can lower taxes to stimulate the economy. They can raise them to slow it down. Tax changes on certain industries or products will pinpoint stimulus or slow things down. Change taxes on investments, like lowering capital gains tax, stimulates investment. Create deficits in bad times to stimulate the economy and cut back spending in good times. This is Keynesian economics. Automatic stabilizers are programs that cause the government to spend more or spend less depending on what's going on in the economy. An example of this is unemployment insurance, which automatically increases when jobs are lost and automatically shrinks when jobs are plentiful. Economic policies. These are actions performed by the central bank. The central bank is always defined as separate from government, but in reality it's a lot closer than people realize. Examples of central banks are the Bank of Canada and the U.S. Federal Reserve. Policy is basic microeconomic activity used to promote economic growth, job growth, steady or low inflation. Central banks can expand or contract money supply depending on their objectives. Central bank determines short-term interest rates, and they are practicing quantitative easing, money printing and buying back bonds with the money. Buying new government-issued debt or bonds and debentures on the open market also is a tool they can use to keep rates low. Monetary policy. Central banks can react to economic data. They'll stimulate in reaction to poor economic data, and vice versa. Stocks have a tendency to do well when the Fed is not tightening to raise rates. Therefore, poor or slow growth and economic data can actually be a positive for stocks. Real estate sales do well when interest rates are low or are falling, and interest-sensitive investments favor weak economic data and falling rates, so utilities and so forth, high dividend-paying stocks. Low inflation helps the Fed to keep interest rates low. Quantitative easing and money supply growth promote economic activity, and the opposite happens when the economy is tight. When the Fed tightens, they tighten typically to slow overheated economic activity. The yield curve and the economy. The yield curve is a set of data that reflects interest rates at all maturity levels. Since 1950, with the exception of one case, an inverted yield curve has been a precursor to every recession. It's been a very reliable recession indicator. An inverted yield curve is where the short-term interest rates are lower than long-term interest rates. And it can be across the whole curve, or it can be across a piece of the curve. Usually the key factor to pay attention to is the difference between 2- and 10-year rates. This occurs when the central bank raises short-term rates and causes bond investors to buy long-term bonds in anticipation of a slower economy. A slower economy usually brings lower inflation, which is attractive to longer-term bondholders. Unfortunately, the Fed may overdo it and cause a recession. So buy interest-sensitive investments when you see an inverted yield curve. Stay out, be wary of them when the yield curve is positive or steep, the normal yield curve or a steep normal yield curve. Now, if you're interested in going to the U.S. Treasury yield curve site, there's a link on page 9. Inverted yield curves and recessions. In the chart below, when the blue line goes to 0, or below the yield curve, the yield curve is inverted. The gray shaded areas show recessions that followed soon after. So it's pretty obvious. Inverted yield curve, likely to cause a recession. Doesn't always happen. Almost always happens when there has been a recession. We'll have seen an inverted yield curve. Inverted yield curves don't always cause recessions. More often than not, they do go in tandem, however. So here we are in a world today of unprecedented negative yields. The gap between yields on 2- and 10-year Treasury notes, a measure of the yield curve, fell to about 75.5 basis points in mid-2016, the flattest since November 2007. This means that 2-year and 10-year rates were almost the same, as shown by data compiled by Bloomberg. The narrowing accelerated after the UK vote to exit European Union dimmed world economic growth prospects and pushed more global yields below 0, boosting the appeal of treasuries. Add to that the Federal Reserve's tightening bias, and the trend is set to continue. We could be heading towards another inverted yield curve and possibly a recession. Central banks and currency rates. Currency manipulation occurs when countries sell their own currencies in the foreign exchange market, usually against the U.S. dollars, to keep their exchange rates weak and the U.S. dollar strong. These countries therefore thereby subsidize their exports and raise the price of their imports, sometimes by as much as 30 or 40%. Usually there are agreements between central banks to regulate these flows. Moving on to the economic cycle. The economic cycle goes in waves, and you can start it anywhere you like. A sensible place to start the economic cycle, different from what it shows on the slide here, is at the late upswing phase. This is when there's a boom mentality, inflation gradually picks up, policy becomes restrictive, short rates are rising, bond yields rise, stock markets are topping out, commodities are rising strongly, and property prices are rising strongly. Does this remind you of anything you've seen lately? Usually in the late upswing cycle is followed by a slowdown. The economy slows, enters recession perhaps, confidence suddenly drops, inflation continues to rise, inventory correction begins. In the markets, short-term rates peak, bond yields top out, stock market starts falling, commodities start falling, and property prices top out. If it accelerates to a recession, confidence weakens further, inflation peaks, production falls, short-term rates drop, bond yields drop, stock market bottoms, commodities become weak, property prices are weak. And of course, just as it looks the darkest, that's the day before dawn. Dawn in the economic cycle is the recovery phase, stimulatory economic policies, confidence picks up, inflation falls, short-term rates low or falling, bond yields bottoming, stock market rising, commodities rising, property prices probably bottoming. And then the early upswing phase, which is just before the late upswing phase where we started, early upswing phase increases in confidence, healthy economic growth, inflation remains low, short-term rates are normal, bonds are stable. It doesn't say it here, but the yield curve will probably normalize, which means that it's gone through a flattening phase. Now short-term rates are lower than long-term rates where they should be. Stock market wakes up, commodities become stronger, and property prices start to pick up too. And that cycle repeats itself over and over and over again. It's very important to know where you are in the economic cycle, especially as an investor. Page 15, slide 15, it's got a lot of the same things summarized that we just talked about before. And that's the end of the economic cycle commentary, main section. The economic commentary cycle will follow with some charts. Thanks for listening.